Okay, we're gonna get started. We have first thing we're gonna do is we're gonna look at the S&P 500. You can see we're monitoring the moving averages. We have the 200-day, 300-day, the 200-day. This is the 100-day moving average, and this is the 50-day moving average. You can see that we basically bounced off the 100-day moving average, and we're now at the 50-day moving average. All right. So we had let's look at our calendar. Okay, our calendar. Um we were expecting a good day this week, good week this week because we were totally oversold last week and we did have earnings coming out this week. A lot of the big tech stocks such as Google, Microsoft, Apple, and Facebook are reporting at the end of April. So that today that helped stock market go up. So we're basically, if we look at our stochastics, we're 40, that's like still oversold, and we're going up. So we're almost halfway between overbought and oversold. Okay, so um, let's look at our calendar and what's going on next. Next week, we're going to have the Fed has a meeting at the end of April, and they're going to announce interest rate information for us. Most likely, what's happening is we're having stubborn inflation, and that's causing the stock market to um, be a little iffy. And right now, the bonds have been going up this week, and that has hurt the stocks. So let's look at what else is happening here. We're going to have a holiday coming up in June, and we're going to have another holiday July. So a lot of times around holidays, the stock market does pretty good. Let's look at some of the market movers for today. Okay, Alphabet, they're up 10%. They're basically one of the stocks that are doing really good. Going back a couple years, they're in a constant uptrend, it seems. Let's look at some of the stochastics for Google right now. Okay, you can see this is one of the only stocks we're following that's in a reliable channel. And it basically broke out of this reliable channel this today. Might be going into a new uptrend, we don't know. But as other stocks, like the AI stocks are falling out of their channels, Google is actually staying within their channel. Let's look at the other stocks that are going up. Well, the big earnings announcements this week have been Facebook or Meta and Alphabet. They both indicated they're spending very heavily on AI and most likely buying chips from NVIDIA, which is why NVIDIA is up today and Supermicro is a derivative of NVIDIA. So, so a lot of the AI stocks today are going up. And a lot of the stocks, let me see hmm, there's no real common thread for these stocks that are going down. Okay, let's look at the sectors. Okay, so the sectors that are doing the best and the worst. Seems like almost every sector is doing okay except for energy and utilities. Energy has been doing really good so far this year. It's up 13%, one of the best performing sectors in utilities, and are not doing so good. The ones doing the best are communication services, primarily because Google is in that group, and it went up 10% today. Technology, and so whenever a stock like Google reports really good earnings and excites the market, all tech stocks around that sector are going to be doing better. Okay, so okay. So it seems like the S&P, let's look at our stochastics for the S&P. Okay, so it looks like the S&P is staying within a channel still. We have um we had to alter our channel just a little bit um to adapt to the price action here. But it seems like we're still within an uptrend. So that's good because the stock market, 90% of stocks follow the S&P 500. Okay, so let's look at some of our meeting notes. Okay, so the 10-year and the 2-year are actually up 1% and 2% from last week. Usually that's a bad sign for the stock market. And we do still have an inverse correlation between the US Treasury yield, which and the S&P 500. As it went up in the past month, the stock market has gone down. You can see that the purple line is the S&P, and the blue line going up is the yield in the Treasury. The simple reason for that is the if there is a guaranteed yield that's high, people are not going to risk money in the stock market. All right, so okay, so let's look at some things to keep in mind. We are in April, May time is probably some of the best times of the year, seasonality wise, and and we're coming into May, which is another seasonally good month. That's why we have green on the calendar for the rest of April here and beginning of May. All right, so we have NVIDIA earnings coming out on May 22nd. That usually helps the market because NVIDIA, everything is pointing towards NVIDIA having a very good earnings report because everyone's buying their chips to compete in AI right now. Okay, so if we look at our stochastics for each of these sectors that we're following, almost all of them were oversold last week whenever we were going over this. You can see almost everyone was at a crucial point, and right here last week, QQQ. Now they're basically bouncing from that support and they're halfway between their channels for the most part. Defense sector hasn't recovered yet. It's still in its own little world. It's oversold and it's at the bottom of its channel. We have gold. It's still in an uptrend, but it's becoming oversold. XLY, this is consumer discretionary. They are halfway again, just like the S&P, halfway between overbought and oversold. And XLB is oversold. And XLC, it's actually it was oversold last week and it's starting to bounce off of its oversold. So it's almost halfway between overbought and oversold. And XLV is at the bottom of its channel and it's around 30, so it's oversold also. And let's see what else we can find. So a lot of these are the same. Real estate, it's oversold still, and it's still near the bottom of their channel. XLE, this is energy sector. Energy has been up 13% this year. That's one of the best sectors in the stock market. They're oversold and they're at 40 in the stochastics. So they're almost halfway between overbought and oversold, but you can see they're at the bottom of their channel. And let me see, what else can we find? Uranium is actually one of the only sectors, ETFs, it's in an uptrend and it's been an uptrend for 2 years. It's near oversold and it's at the bottom of its channel. All right. So let's go back and look at more market movers. Let's look at the NASDAQ market movers. Okay, you can see that every one of these in the top 10 is AI related. Um, Alphabet basically said in their earnings call that they are ahead of everyone in AI, and everyone else has to spend heavily to catch up with them. And they had a much better earnings report than expected, and they're actually buying back stock too. So let's look at some of our meeting notes. Okay. So we're actually losing, you see, we're losing momentum. No, we're gaining momentum this week. Last week we had 33% of the S&P above the 50-day. Now it's 44. Last week it was 69. Now it's 71. So we're actually gaining a little bit of momentum. And we did have some corporate buybacks. Google announced $70 billion buyback plan and a dividend on top of that. So that'll get a whole new level of investors interested in the stock if it pays a dividend. So we had on the front page of Yahoo Finance, we have new inflation reading reinforces Fed's higher for longer stance. A lot of the high-flying, very expensive stocks in the stock market were counting on interest rate cuts. And what's happening in general is that we're not going to have interest rate cuts this year, or not as many as they expected, because of inflation's pretty sticky. So that's going to cause a lot of the stocks that depend on borrowing money to go down or not do as good. Let me see. Okay, consumer sentiment falls as inflation expectations climb. Basically, consumer sentiment is like a one-to-one correlation to the S&P 500. When stocks go down, consumer sentiment usually goes down. And whenever the stock market's doing good, consumer sentiment goes up. So I'm not sure why people pay attention to that reading. Okay. So we have what else do we have going on here? Okay. So let's look at some of our meeting notes. Okay. Okay. So I already mentioned this. We're oversold still with the S&P. We're near the bottom of our channel, and that we're almost 40 in our stochastics. So that's why we have green in the next week. Okay, the U.S. Treasury, of course, it's going down today. We had, and it's still a one-to-one inverse correlation to the S&P. All right, and same with the 2-year. And okay, so oil isn't going much anywhere, and inflation, a lot of our key variables in the stock market aren't really moving at all. We saw gold go down a little bit. I guess whenever people are fearful, like we had last week, people buy gold as a hedge. If the stock market crashes, gold is going to go up because it's a more certain over time investment. But it's down 3%, most likely because the stock market's been rallying. Okay, so fear greed index, we're less fear than last week. Last week we were at 32, and now it's 42. So this is the time that we're oversold in the stock market, and we're approaching it seasonality, good time of the year in the stock market. May, April are good months. So this is the time to buy if you have some dry powder or you're interested in buying things. And also we have another indicator indicating it's a good time to buy. The AII sentiment survey has more bearish for the first time than bullish. So that's an indication that another indication it's time to buy, or it's definitely not time to sell. Um, okay, and we have the dollar index continues its uptrend. So as the dollar goes up, that's a headwind for a lot of the multinational companies, and we have to keep our eye on that. If it gets this has a direct effect on the price of gold and oil too, the US dollar. All right, so let's look at the VIX. The VIX is now 15. It's when people are fearful, the VIX goes up. And when they're not fearful, it goes down. So it went down like like 5% since last week. Kind of in a range like this, with the low being around 12 or 13 and the high being um, probably 18 or so. So people aren't right now reaching for a whole lot of protection for their portfolio. Okay, so we're still fearful, but we're not as fearful as we were last week. A lot of the things we were worried about last week, such as the AI bubble, basically corrected themselves because we had earnings reports, and the earnings reports for Google exceeded expectations, and they're one of the biggest AI companies out there. Okay, so and Magnificent Seven stocks being overvalued, we're actually we had a couple earnings reports we'll go over later on, Google and Meta. Um, Google is actually with their new earnings, it's almost fairly valued. So a lot of times earnings that are better, they um, they help a lot of the fears about the Magnificent Seven being overvalued. Okay, consumer debt, we haven't had any problems with that this week. We still have problems with Israel and Iran, a couple other oil-related countries. Okay, so let's look at, okay, the S&P is still overvalued, probably by 20%, by historical means. We still have a good reversion to the mean. We had the winners of last year doing good. It's doing okay, but the losers from last year are still doing pretty good. Energy is the leader this year, up 13%. And interest rates were expected to go down this year, but they haven't. And that is affecting a lot of the companies that need to borrow, like biotechs and tech companies. We're still having this week, the AI revolution will juice stocks involved. That is playing out in our top 10 that we just looked at today. And it seems like weight loss drug companies are losing their momentum. They're not really, we might need a couple of rounds of earnings before they go up again. Okay. Okay, we already looked at the market movers for today. Okay, we had a problem with Meta this week. Meta went down 10% one day. I think it was yesterday. And that it was up 43%, but it's still up 23% this year. Meta is actually in the process of spending in a major way on AI, and the earnings were the amount of money they made was great, and they met their earnings, but they projected they're going to spend a lot, and that projection took them down 10%. But it's still one of the best performing stocks this year in the stock market. Amazon is up 6.9%. It went up another 3 or 4% today. And XBI is starting to outperform. It's up 6% this year. All right. But the Chinese stocks still aren't doing very well. All right. So here's some charts that I looked at. And we looked at Meta. Meta is actually, you can see that it broke a lot of its momentum. And a lot of times there's something called a 3-day roll. Whenever a stock goes down 15 or 10%, you have to wait 3 days and then wait for all the earnings to be all the analysts to revise their earnings estimates and then figure out where the stock is before you even start looking at it. Okay, but it's basically still in an uptrend channel. But if it breaks below this, that's a sign that it's going to go lower. And these moving averages are what are used for support. But this level right here where it broke out of is probably the next step if it goes below this trend line. All right, let's look at CMG. This is one of the best performing stocks we're following. And they're going to have a split coming up. They have a $3,000 priced stock, but they had really good earnings, and they're growing their restaurants at like maybe 57 restaurants that are open this year, and this is one that Bill Ackman owns. So if he owns 4 stocks, and this is one of them that is major 4 stocks, I would seriously look at this as a decent stock to own for like a growth part of your portfolio. But it's overbought right now. Um, Google, we already mentioned this one. It kind of broke out of this uptrend that's been in place for a while. And it went up 10% today. It's not the time to buy the stock because it's overextended. But just remember there's going to be a day when Google sells off 20%. And just keep in the back of your mind, they're still growing at 15, 20%. And they're a compounder. A compounder is a stock that you can buy and hold, and they will continue to deliver for you, a growth over time. I bought this in 2008, and I held it through the financial crisis. And, there's ups and downs, but it's returned like 15% a year, over consistently. And another good thing about Google is they're buying back stock. So that means that you as a shareholder get a better part of the company, bigger portion of the company every time they buy back stock. And that's pretty valuable. And they pay a dividend. So it's less than 1%. It's like 0.5% dividend. But it's still great. Whenever you have a stock that's a growth stock pays a dividend, that's a sign either they're slowing and they're like an old-fashioned company like Microsoft, or you can take it as there's a total new round of investors who would want to demand a stock like this for their portfolio. So so for me it's like it's a stock that keeps on giving. Um, but they said in their earnings call that they're going to they are ahead of the game in AI, and everyone else is playing catch up. Um, so I that's a good sign. Let's look at Amazon. Amazon is still in an uptrend. It's oversold. No one wants it right now, and it's at the bottom of its channel. So I'm just thinking about the moat that Amazon has in um, delivering their merchandise in their warehouses. It's very hard to compete with same day delivery, with um, the moat that they've made in that realm, and they're also making a lot of strides with their AWS with AI. So all right, but that's a good sign, and this is one of Dan Now's best picks. Let's look at we already mentioned new inflation reading reinforces Fed's higher for longer stance. So I think it's a PCE came out today, and it was higher than expected, and not that much higher. So it still means that the stock market is probably going to be hurt in a way because the Fed's not going to reduce their interest rates this year that much. So this is a article Alphabet source on strong earnings, first ever dividend, and $70 billion buyback. So Google has a lot of cash. We're going to look at their numbers pretty quick next. But everyone was worried that they were falling behind in AI, and they gave some pretty poor examples, demonstrations of their Bard like a while ago, and it dropped like a rock. And now it's a little bit they're tempering their fears. They still have a lot of warts, like potential antitrust issues. Um, but it seems like things are pretty good for Alphabet now. Let's look at their earnings. They're expected to grow around 15% for the next couple of years. And they gave an indication that in their earnings report this week that they're projecting like between 15 and 25% growth in some of their um, services they offer. So it looks very strong. Um, I would, with all this earnings information, this is not the time to buy Google. You have to wait for everyone to be negative on it and keep this in the back of your mind that they're doing, all these great things. So you have to like think contrary. But it is the perfect example of a compounder, something you put in your portfolio and expect it to grow like 15% a year. Um, let's look at the next one. This is Google's financials. You can see this matches it's a PEG ratio of 1.65. We have, rats. We have a profit margin of 25. That's better than the 13 we actually look for. And return on equity is 29. We expect like at least the 13 on return on equity. But the big part about Google is they have a total cash of $108 billion. So they're actually buying back stock with a lot of the cash they have. So that'll allow the stock, that'll also give a certain amount of stability to the stock in the future. So if there's dips in the stock and the stock goes down, there's a good chance Google could be buying back their stock, and that'll make the price go up. All right. And the opposite side of things, we have Facebook, first ever drop in daily users. It seems like Facebook could be getting to a point where they think they're falling behind and they need to spend a lot to catch up with the competition. So they're losing daily users, and they're spending a lot on AI and these chips from NVIDIA. That shook the market, and the stock market went down earlier this week. Let me see. Hold on. Oh, this is Facebook. So I'm sorry. I said Meta, but yeah, this is Meta. So you can see that they're growing around 15% a year, and their forward PE is 21. So they're a little bit more fairly valued than Google right now. But we'll keep our eyes on these earnings estimates because that could be going down as they say that their spending is going up. So basically, Meta has to spend a lot on AI, and that's hurting their earnings. All right, so you can see that they have very similar. This is almost exactly the same as Google. Their PE, their profit margin, return on equity is all really good. And they have $58 billion in cash too. So it's very, very similar to Google, but Google has a little more tailwinds and they have a little more of a moat. And they have an advantage on AI. All right. So, okay. Hold on. Okay. So, hold on. I gotta get. Okay, I have to go over this another time. Basically, this guy had this article um, on Twitter. It didn't come out very good here. Okay, it is basically the effects of interest rates. Let me see. Hold on. I'm gonna search for this on a Google on. Okay, we'll go over that next time. Basically, what he's saying is if you have higher interest rates, and its effect on equities. So if you lower the interest rates, he said 10-year treasuries yield rules everything in the markets. So as the interest rates go down and you have like a zero interest rate environment, then the PE ratios of the stock market goes up because people pay more for stocks. So you have a chance where everything is overvalued like we did during the pandemic. But if you raise the rates too high, then the PE ratios for the stocks actually go down because people are not willing to pay as much for stocks. So there's like a balance that the Fed is trying to have, like right in the middle, where it doesn't raise too much and it keeps stocks and assets at a median level. So I'll go over this next time. It didn't really print out very well. Hold on. All right. Okay. There's another article. If I had to construct a portfolio of just 5 ETFs, here's exactly what I would buy right now. And this is a guy from the Motley Fool. He says he would put 50% in the S&P 500. And then with the rest of his ETF portfolio, he would put 12.5 equal amounts into the Vanguard Small Cap ETF, International ETF, Real Estate ETF, and Total Bond Market ETF. And how he allocated, how much that you put into these different sectors, he said, subtract my age from 110 to determine the percentage of assets should be in stocks. And in his 40s, for instance, that means he should keep 70% in stocks. So if he was 50s, it would be 60%. And then that's, he said, this is interesting, half of my stock allocation in the S&P 500 index fund. But he expects 10% average returns for all the stock related. So the first 3 here are stock related. And then the last 2 are more income oriented. They would yield 5%, 4 to 5%, and the stock portion should yield around 10%. So that's I thought that was an interesting way to have a portfolio. If you're starting out from scratch, you might want to use that technique of subtracting your age from 110 to determine your amount in stocks. So that was interesting. And let me see. All right. So let's go back and let's look at how we go about, timing the market, timing investments in the stock market. This is the S&P example. Whenever we're looking at a stock or an ETF or related, we can look at treasuries too. But we usually try to draw trend lines. So you basically draw a line at the top of the chart and the bottom of the chart, and you try to usually it matches. You have this, a equally divided parallel line, and whenever it's at the top of the channel, you don't buy it or you sell it, or when it's at the bottom of the channel, whenever the stochastics are at the bottom, you buy it. So we had almost the whole entire stock market last week at the bottom part of the channel and oversold. And that was due to a lot of the geopolitical problems, a lot of the problems with interest rates continuing to go up. So that's the way we're using stochastics. And we wait for extreme fear or fear to buy. So we had fear last week, and there's still fear this week. But it's getting to a point where people are confident again. And you also try to balance out your sectors into growth and income ratio. This is my portfolio. I have, a certain amount in tech and healthcare and financials. What this guy did at the Motley Fool, he actually went and he did that same thing with index funds. So if you want to use index funds, they're a good way to diversify, and it's a little bit simpler because you don't have as many stocks that you have to follow, and you can just take a whole. And this is a little bit it's a little bit better way to it's more diversified, so you don't take as many risks with individual stocks. And but if you do have a portfolio, you want to have a certain amount in every different type of sector. And the last thing I wanted to review, like I always do, is the what makes a good growth stock. This is kind of my specialty because most of my portfolio is made up of stocks that are growth stocks. You want to look for a stock with high free cash flow. If you're looking for a growth stock and their earnings that are continuously going up. We just looked at Google this today, and it was going up 15% regularly. We're looking for a return on equity greater than 12. For instance, Google and Meta were actually in the 30s. Profit margin greater than 12. We had Meta and Google right around 30. Market cap. We like bigger market caps because they're a little bit more reliable. Forward PE, we want it to be low compared to the growth rate. And we like the growth rate to be greater than or equal to 10. And that allows us over time to grow our money in a way that's better than bonds. If you wanted a growth rate greater than or equal to 5, you might as well have your money in a 5% treasury. So, and PEG ratio, we try to buy around 1.0 PEG ratio, but if it's a quality stock, such as Costco, that continually grows at 10%, it's going to trade at a higher PEG ratio. The more reliability a company has, the higher PEG ratio it trades at. And we try to buy a PEG with a PEG ratio of less than 1, if possible. The lower, the better. And we like a return on equity greater than 10. We want the company to have a competitive edge. And if it pays a dividend, that's an added bonus. And we want it to be have little or no debt. We just looked at Google and Facebook or Meta today. Both of them had near $100 billion in cash. So those are some, and good management. We want a stock that is led by someone with a proven track record. All right, so that is in essence what this whole talk is about. I do this every week just because it helps me organize my investments, and it helps me keep up with everything that I own. And if I didn't do this, I might just miss a certain earnings report or miss something very important that would affect my portfolio. But you have to pretty much ignore a lot of the day-to-day price movements. And if a stock goes down, that doesn't mean it's a broken stock. It could be just the stock is volatile. And that's all. Okay, great. Well, I think that's all I had to share for today. If you have any questions, let me know, and I'll include it on the next session. I hope you have a good investing week next week, and I'll see you next time.